Hey there, my name is Brandon Peek and I work for Sherman Bridge Lending. My focus here is providing alternate short-term or bridge financing options for borrowers whose needs are not met by banks or other traditional lending institutions. I provide loans for rehab investments in the DFW area. I am also a licensed loan officer, or in today's terms, an RMLO. I can handle the financing, refinancing of investments, or the financing or refinancing of your owner-occupied properties. Sherman Bridge can handle all your real estate financing needs. Also in this video, I'd like to cover the concepts of hard money versus cash, or hard money versus conventional financing.
Okay, going through the presentation today, we're going to talk about hard money, how it's defined, how investors use hard money, the key terms and lingo, cash versus hard money versus conventional lending when it comes to financing these distressed properties. Hard money is defined as a specific type of asset-based loan financing through which a borrower receives funds secured by the value of the parcel of real estate. Hard money loans are typically issued by private investors or companies, such as Sherman Bridge Lending. Knowing how to use hard money is key, as hard money loans are designed to be used as temporary financing to acquire and rehabilitate distressed properties that will not qualify for traditional methods of financing. The goal of the borrower is either to sell the property for a profit after the rehabilitation has been completed, or refinance the property into a conventional loan and retain long-term cash flow. Investors prefer using hard money loans over other methods because of the product's speed, ease of use, and the added leverage attained by financing the entire rehabilitation cost of the project along with the purchase price. As with all collateralized loans, the size, rate, and length of hard money loan is determined by the volatility of the asset and the marketplace, as well as the financial standing of the borrower. Throughout the rest of this video, I'm going to be using some key terms or lingo. ARV being the first one, which stands for after repair value. This is the value of the property after it has been rehabbed. Loan to value is the LTV, the amount of money lent to the borrower based off the asset. And a lot of times those go together in the same sentence, so they correlate. Rate is the percentage charged in interest. Points is the cost of money. Refi is just short for refinance. Typically a loan product to reduce your current interest rate. Normally it's long term. Out of pocket, the amount of skin in the game. Here is our cash versus hard money scenario. Let's say as an investor you have $150,000 to invest. And in our cash versus hard money scenario, we're going to compare an alike property. Actually, we're going to compare the same property. The ARV is going to be $100,000. with the purchase price being $50,000 and a rehab cost of $20,000. Now on the cash side, your total investment is going to be $70,000 with a gross potential profit of $30,000. Now on the hard money side, we lend up to 70% of the ARV and your out-of-pocket cost is roughly half of the rehab. Here your rehab is $20,000, so your out-of-pocket cost is about $10,000. And you're still going to have your gross potential profit of $30,000. Now the important thing here is to look at your cash left to invest. If you had $150,000 to invest and you spent $70,000 on your first property, then you have $80,000 left to invest on another property. And that's the cash side. Now on the hard money side, if you had $150,000 and you spent about $10,000 to get into your first property, this means you would have about $140,000 left to invest. So your gross potential profit of 30 times more properties. Now on this cash versus hard money scenario, on the cash side, all you have really saved by paying all of the cash, the $70,000 in this total investment on this property, is you've saved the financing costs. Whereas on the hard money side, you paid the financing costs. And our typical investors are somewhere out of pocket between $10,000 and $15,000 per transaction. The other scenario that I would like to cover is the conventional lending side versus the hard money side. And we're going to again use the ARV of $100,000 with the purchase price of $55,000 and the repairs of $20,000. Conventional bank lending typically have lower rates, and they will lend up to 80% of the purchase. So that would require you to have a 20% down, and in this scenario 20% of our ARV would be $11,000. Now what they won't lend is the cost of repairs. So your out of pocket is the 20% down plus repairs, and in this scenario your out of pocket is $31,000, which would get you an ROI of 65%. Now on the hard money side, we typically have a higher rate, but we will lend 70% of the ARV, and that includes repairs. So in this scenario, with repairs being $20,000, and like I mentioned in the cash versus hard money, your out of pocket is roughly half the repair cost. So here's $20,000, your out of pocket would be roughly $10,000, which could get you an ROI of 200%. Alright, this is a graph going back to our cash versus hard money scenario where we had $150,000 to invest, and we spent $70,000 on our first investment, and we were left with $80,000 left to invest. So on this graph we have our $80,000 balance here of the cash that we have on hand. And we've decided that hard money is the way to go when financing the rest of our investments. But there's a little bit of a challenge, and that is the cash depletion versus the cash requirements that you have in reserve. So the more houses that you acquire, the more cash reserve you're going to need, and obviously as you acquire more houses, your cash is going to deplete. And this graph is going to show you where your personal threshold lies. Here with our $80,000, we can acquire 5 houses. Now that we have covered the concept of hard money and the scenarios of cash versus hard money and hard money versus conventional lending, the challenges of cash depletion versus cash reserves, I would also like to let you know that other than being a private bridge lender, we are a mortgage bank, meaning I can help you with your FHA, VA, or conventional loans. That might be the financing of your personal residence or a refinance after you've gotten into a hard money loan for an investment property. We also offer alternative loan products, and we're one of the few that offer the IRA non-recourse loans. And we can also do IRA hard money loans as well, and IRA cash out loans. Now that we've covered all of the ways that I can fund your investments or your owner-occupied properties, let's get into a little bit about the exit strategies. I just want to cover a few of the most popular, and one of those being flipping, and this is where an investor would purchase and rehab a property and then sell the property, typically a conventional sell, and inside his term of his hard money loan, which is normally 6 months, to repay his hard money loan, and then he would collect his profit. The other one that investors like to use for long term is rentals, and this is where an investor would purchase and rehab a property, but instead of selling it, he would refinance the property into a conventional product where he would be lowering his interest rate, and it's typically a long-term loan product which would help maximize the cash flow and the rate of return. The other one that's pretty popular is seller finance. Now this is a little bit more complex, and this kind of converts your asset from a property to a note, but basically the investor becomes playing the role of a bank. There is much more to all of these exit strategies in different videos. Those and more can be found on my YouTube channel. Please go check it out.
Thanks for watching, and if you have any questions, please contact me directly at the contact information below. If you're looking for more educational videos, please check out my YouTube channel, also listed below. And thanks again.